Hey there, thanks for tuning in to another RTD News Updates. And as always, the articles, if you enjoy them, feel free to share them with your family and friends to help them become more monetarily aware. As well as if you're new to Rethinking a Dollar, click the subscribe button below for more RTD news as well as interviews. Let's get into the articles. Today I have a variety of articles. The first one here, the Bank for International Settlements warns that a major debt meltdown is imminent in China. The next one, world money and hyperinflation. Are you ready for the next recession? Canada's household debt exceeds total GDP for the first time. And the last one, central banks have been buying gold with a vengeance. And before we actually get into the interviews, I want to direct your attention to the RTD Cashless Society t-shirt giveaway. This Friday, I will be selecting a winner for the giveaway, looking to help people become more monetarily aware by helping them to be able to be the messenger themselves by having people ask them questions. So more details below if you guys are interested in doing such. Let's get into our first article. Here's an article here from Washington's blog by Michael Snyder. The Bank for International Settlements warns that a major debt meltdown in China is imminent. And so for the most part, he talks about how the debt bubble in China has grown to the point where it eventually has to correct itself in the form of it bursting. And then he goes on to talk about how just the overall bond market, he quotes Michael Pinto towards the bottom, saying that how bond market itself is just, beyond being sustained, and that we are technically in a recession because up to now, earnings for corporate earnings, right, for five or so quarters in a row have all been down. And whenever stuff like that has happened in the past, it has always led to some type of correction in the form of a recession, which has also adjusted the stock market majorly. So just to give you an idea of what some of the things he's talking about here, the pinnacle of the global financial system is warning that conditions are ripe for a full-blown banking crisis in China. Since the last financial crisis, there has been a credit boom in China that is really unprecedented in world history. At this point, the total value of all outstanding loans in China has hit a grand total of more than $28 trillion. That is essentially equivalent to the commercial banking systems of the United States and Japan combined. While it is true that government debt is under control in China, corporate debt is now 171% of GDP. And it's only a matter of time before the debt bubble horribly burst. Then he goes on just to quote a couple statements made by the Bank of International Settlements, who is the bank of all banks, central banks that is. It is not too often they come out and actually just spill the beans saying or commenting on how bad something really is. And so here we have a quote here. It said, key gauge of credit vulnerability is now 3 times over the danger threshold and has continued to deteriorate despite pledges by Chinese Premier Li Jingpu, I'm not pronouncing that incorrectly, I'm sure, to wean the economy off debt-driven growth before it's too late. The Bank for International Settlements warning is quarterly report that China's credit to GDP gap has reached 30.1, the highest to date, and in a different league altogether from any other major country tracked by this institution. Studies of earlier banking crises around the world over the last 60 years suggest that any score above 10 requires careful monitoring. So he goes on to talk about the Bank of International Settlements and how they were formed, and how they're a conglomerate of 58 global central banks and how they were unelected, and so no one has actual authority over them. So, and they actually make all the decisions for the central banks, even more so than politicians have in individual countries. And then quotes Michael Pinto, as I mentioned before. And one of the things here that Michael Pinto was quoted saying recently is, when the bond market breaks, when that bubble bursts, it will wipe out every asset. Everything will collapse together. I mean, diamonds, sports, cars, mutual funds, municipal bonds, fixed income, real estate, collateralized loan obligations, stocks, bonds, even commodities will collapse in tandem along with the bond bubble burst. So you have multiple people, even the central bank of central banks, mentioning that things are getting out of control. And so we are approaching or currently in something that is considered to be imminent. So a major meltdown. So articles below if you guys are interested in checking it out. Here's an article from the Daily Reckoning by Mr. James Rickards, and it's entitled World Money and Hyperinflation. And for those that are aware of Mr. Rickards, he's a big SDR gentleman who speaks highly about just the global money that's been pushed and that will be altered on October 1st when the yuan enters the basket of world currencies. And so he actually goes into a small little bit of history about how that special drawing rights was created and how it's formed, and how during the last crisis, a lot of higher ups were, really pushing for its implementation more into the system. And it mentions here in 2009, U.S. Treasury Secretary Timothy Geithner supported it. 2015, United Nations Jose Antonio Ocampo calling for new issues of SDRs with a disproportionate share going to emerging markets. And so he's basically saying that, it is now mainstream that the SDR will be pushed out, and eventually it being pushed out, as he put it here, the SDR has the power to reduce the dollar to the status of a local currency, no different than a Mexican peso. And so he talks about here, when that happens, hyperinflation will be on the horizon. And he kind of, moves away from the typical spiel of hyperinflation of just, too much money printing, because he actually says that, a lot of money or credit creation was already done from the last fiasco that happened. And so he says the source of hyperinflation is not money printing that already happened, but the rapid turnover of money. Those who lack confidence in dollars as a store of value will quickly dump dollars for other assets. Then he goes, in this scenario, the alternative to the dollar can be as familiar as gold, land. It could be one of the new digital assets such as Bitcoin. The dollar alternative could even consist of natural resources such as oil and water. But then he goes on here to talk about when it comes to hyperinflation, the alternative doesn't matter that much. What matters is that investors will dump dollars as fast as they get them. The resulting turnover, what economists call the velocity, will feed on itself and lead to skyrocketing dollar prices. A better understanding is that assets, goods, services have a constant real value, while the dollar itself is collapsing. The dollar devaluation is the real source of higher prices. After all, gold is gold, land is land, water is water. When you see hyperinflation, you are really seeing the collapse of the dollar relative to other things that dollars can buy. So he's saying that basically in the days ahead, the SDR moving in will basically reduce the usage of dollars, bringing them all back home, which will then lead to a lack of confidence in the paper, and people will begin exchanging those things at a rapid pace, trying to get real tangible items that they need. So great article as always. If you want to check it out, it's below. Here's our article here from the Mises Wire, and it's "Are You Ready for the Next Recession?" And the author here, Brandon Brown, kind of just paints over the mainstream narrative of that we're in a recovery, and kind of goes into detail as to how that really isn't the case. So he talks about the current cycle, business cycle, and how supposedly we're on a uptrend, but in actuality, when you look at everything that's going on, the policy and things like that is in place, all this easing happening globally, we're clearly heading in a downtrend. So he talks about why 3 reasons why we're told not to worry. And so as far as the mainstream media, as well as all the central banks come out and say, don't worry, we got this under control. And it says, to be fair, the optimists on the shallowness of the next recession are not citing a past historical episode to back their case. Rather, they make 3 claims. 1, because investment spending has been so anemic, its scope to fall is correspondingly limited. The likely tumble in asset prices will not this time cripple the U.S. banking system, which is not unusually resilient. And 3, the new tools which the central banks have tried out during the experiment so far now can be sharpened and adapted to better combat the next recession when it all hits. And so that's kind of like the narrative we've been told. But then he gets into why that's not really the case. He talks about weak business spending, declining consumption, and popping bubbles. And he talks about the whole easy money policy has led to malinvestment, which has kind of created the illusion that things are on the up and up. But yet, overall, people are really feeling it because they're not spending as much. So more people are chasing yield, more hedge fund managers are chasing yield, which is actually hurting them, which is increasing and promoting these inflation in certain asset classes, which is bound to pop. And he talks about how in the days ahead, while we should be skeptical of claims that there is no potential U.S. banking crisis, explaining the whole banking fiasco that's underway globally and how it's not really being tamed because nothing's really improved. And then he goes on to talk about here how this upcoming presidential election will really play into next year, how they deal with the official announcement of the recession, whether or not they continue on with this current Fed model of looking towards these tools in their toolbox, as he puts it, that to help us, or will the president make some decisions fire some Fed people, move away from that, and implement some type of sound money policy, which can help eventually one day stabilize what's going on now and what's coming. So a lot more details inside if you want to check it out. Just kind of gave you an overall summary. Other than that, hope you guys enjoyed it. Check it out if you're interested. Here's an article here from Armstrong Economics, and this is Canada's household debt exceeds total GDP for the first time. So Martin Armstrong basically does a good job of summarizing what's going on in a very concise way. So it's a very short article, but just the graphs themselves speak for themselves. It says for the first time in history, the total private debt of the Canadian public has exceeded the total national gross domestic product after reaching 100.7%. This is significantly higher than the United States, which has been declining since 2008. Household debt in the United States is now under 80% of GDP. Clearly, Canada's private household debt is counter trend. So Canadians, obviously are in a different state as far as they're willing to become more indebted to the system, and so they're borrowing more and for the most part living off credit more so than here in the United States, where we're borrowing more, but yet it's not as high as it was in the past. So interesting graphs here when you see the household debt to GDP for Germany heading straight down. People are, more so getting out of debt there, trying to, tighten up things in their home front. And it says household debt to GDP. I'm not sure where this is at, but yet it's also going down. I think this is probably the United States. Yeah, the United States. So other than that, this is what's happening in the news. People are using less debt for the most part and trying to get out of debt in a good way, but yet that's hurting this credit and consumption-driven economy. So great article. If you want to check it out, and check out these graphs. Here's the last article here from Market Watch, and after all the prior interview or articles rather, talking about how bad things were, whether it be with Canada's household debt, the next recession coming, Jim Rickards, SDR, the dollar devaluation, and the Bank of International Settlements mentioning how China's debt is just going through the roof. Here's an article that kind of sums it up as to what the layman should be more interested in as times unwind. We can't do much about the global picture, but you can do something about your own personal economy, as some gentleman put it. And so it says central banks have been buying gold with a vengeance. So here's a great article, and I think it's very interesting because it talks about, just from a historical standpoint, it references the 7 ages of gold put together by the OMFIF research document. And OMI, that stands for Official Monetary and Financial Institutions Forum. And it basically goes through the history of gold being implemented and from a central bank standpoint from 1870 to 1970, and how the trend seems to be moving back into the gold realm as of lately. So it starts off just mentioning some of the obvious. Central banks are creatures of habit, especially when it comes to dealing in gold, no longer formally part of the monetary system, yet still imbued with almost mythical significance by many investors around the world. Not for nothing is the yellow metal still regarded as, in many ways, as a bedrock of world money. Around 20% of all the gold ever mined is held by central bank and governments, with the biggest official holdings accordingly, supposedly, at the U.S. Treasury with 8,134 tons. So it is significant that central banks are turning back to the annual gold purchases in line with a century practice between 1870 and 1970. So the annual purchases of central banks has, increased globally. This appears to be restoring gold as a central element of monetary management after 4 decades of attempted demonetization, according to reserve statistics compiled by the official monetary and financial institution. It says annual net gold purchases of 350 tons a year by world central banks are over the past 8 years have returned to the 100-year average up to 1970, reflecting gold's renewed attractiveness as a safe haven asset in an environment of uncertainty and low or negative interest rates. So it goes on and just kind of list different periods of gold and the history in those periods. And so just to scroll down to the bottom, it talks about initially, it said broad international adoption of the gold standard ushered in period 2 from 1871. Central banks became the guardians of a fixed price system encompassing the buildup of Australian, South African, and U.S. mining output. The gold standard period ended in 1914 because of World War I. And so it says the world economy period 3 runs from 1914 to 1945, spanning the reintroduction of the gold standard, the interwar depression of the gold standard's ultimate 1930 demise, the Second World War II dislocation. Period 4 covers 45 to 73, Bretton Woods. And then period 5, 73 through 98. It says after severing the dollar's official link to gold and the breakdown of the fixed exchange rate, Bretton Woods was a time of falling official holdings and sharp gold price swings. And then even after 28,000 tons of purchase over the past 8 years of period 7, total official holdings as of today is 32,805 tons as of mid 2016. So 32,805 tons are being held by institutions, whether it be central banks or governments currently. And so it says there's still more than 5,500 tons below what was being held in 1965. So just go to show how it's interesting how, governments are recognizing the importance of, re-upping in gold as well as central banks. So if central banks are doing it and governments are doing it, obviously citizens should be doing it. So hope you guys enjoyed this. As I mentioned, if this is informative to you and you find it to be worth your time, please share it with other people so that they can become aware of things such as this article right here, as well as stay in tune with more RTD news and updates and interviews. Looking forward to bringing you more news. See you later.